Alright, hey, how's it going? My name is Chris. This is going to be a little lesson on option scalping. This is just currently my strategy. It's what I do to scalp options. I created No Fee Trading Chat. It's just a chat room for traders to converse with each other, share ideas, help each other out. This is our Twitter and our chat room invite link if you want to join us. Quick disclaimer. I am in no way, shape, or form a licensed financial advisor or planner. I'm, just a dude that trades. Everything I'm going to cover is purely things I have learned over time, and the strategy I use is scalp options. Everything covered in this presentation should be considered my opinion and not financial advice. I assume no liability for any loss you may acquire, but if you want to give me a shout out for some gains, that's cool with me. All right, overview. We're going to be talking about my personal trading rules, how Greeks affect your scalp, the time frames and indicators that I use and why, picking the right contract for the play, and then when to enter, hold, scale out, and exit the play. At the end of this lesson, you should have a pretty familiar, mindset with scalping. If you don't, then I didn't do something right. Uh, if you have any questions, feel free to reach out. But at the end of this lesson, you should have a pretty good understanding of how to scalp. All right, so scalp rules. Rule number one is trade by your means. Use proper risk management. A rule that I've made up and tell people is the triple 10 rule. So that's using maximum of 10% of your portfolio per position. So if you got $1,000 account, you're only taking a $100 position. All right, you're going to target a 10% profit on that position. If you going up and you're making more, that's great. Have a daily goal, try to hit it. But you're going to take 10% profit on that 10% position. What that does is if you hit those two numbers, that gives you a 1% increase on your entire portfolio. And if you can make a 1% increase on your entire portfolio, uh, every day, 100 days, you just increased it 100%. And then you're going to look for 10% maximum loss. So if you take a 10% loss on that 10% position, you're only losing 1% of your entire portfolio. So that's good risk management right there. Play by your means. If you have a $1,000 account, you probably shouldn't have a $500 position. That's 50%. If you take a 25% loss, you just lost a giant chunk of your overall capital. Um, Next one is have a plan. All right, so entry, exit, average down. If you're going to average down, know when you're going to average down. Don't just average down just cause. You're going to want to average down on the next support bounces. As long as they confirm and they hold. And then you're going to want to have a scale out plan. Also, never average up. You're averaging up, you're giving away gains. With options, the beauty of options is you can buy the next strike. So you don't have to average up. If you're in let's say you're in like a $200 call and it's starting to go up and it's like 240, well, you don't have to average up to make more money. You can buy the 240 or the 200.50s, and then you're in a new play. You're not having to average up on your position and losing out on money. You just get another play. Rule number three, stay away from same day expiration. Same day expiration decays so fast and it will lose you so much money. It's just best to stay away from same day expiration. Uh, I try my best to stay away from them because you're in those and you can be up 50% and down 30% in the same 5 minute candle. All right, rule number four is lock in your daily goal. So, my personal daily goal is $300 a day, which roughly 250 trading days equates to 7,500 a year or 75,000 a year. I don't complain if I make more. That's great. I've made a lot more than $300 in one day. I've had $1,000 plus days, $2,000 plus days. I've also had excuse me. $18 days. But definitely lock in your daily goal when you hit it. Next one is cut loss fast. You're going to want to hedge your position as well, if you can, if you know when you're going to. So cut loss fast. By that I mean, if you're planning for a 10% loss and it hits 10%, you better cut that quick, because that 10% loss could turn into a 20 or 30% loss. So there's no reason to keep holding and hoping for a bounce. Hope is not a strategy. Hope is the quickest way in the stock market to lose money. So just go ahead and delete hope totally out of your mindset, because that is not a strategy. But if it's breaking support and you just bought the support bounce, it confirmed, but then it reversed, and now it broke through that support, target your 10% loss, get ready to sell. But if it's coming down to another support and it decides it wants to bounce there, that could be a good time to average down, as long as that's built into your plan. And then hedging your position on the way down, you could buy the opposite trade. So let's say you buy a support bounce, you get in some calls, and then the trade starts to reverse, breaks back through that support. You can get into puts as well and make some profit on the puts as your calls go into the red. And then when your calls hit that next support, you go ahead and average down. It spikes back up, and now you've made money on the puts and the calls. So that's how you hedge your position. You can minimize risk on those calls by buying the opposite trade. Rule number 6 is focus on your size, not the price. All right, you're scalping a set move within the underlying, so the price of the contract is irrelevant. You're going to make your money from the amount of contracts you have, not from how cheap you can get the contract. Because when you're scalping, there's other factors that go into play of how much money you're going to make. And we'll talk about that in the following slides. But focus on the size of your position, trying to get the profit that you want. As long as you're using good risk management, don't worry about the price of the contracts. Rule number 7 is only play the nearest ITM or OTM for scalping. For swinging, you can play whatever you want. But for scalping, it's best to stay closest ITM or OTM, because the moves are so short that you want to maximize the amount of gain you're going to get and minimize the amount of loss that you could potentially take, aka the risk, by keeping as close to the money as possible. So that's why you'll play the nearest ITM or OTM. Don't be this guy and first day of trading with $2,000 and it's gone because he had no rules for himself, no plan, no risk management. He just going in and trying to wing it. Go in there. You can know how to trade stocks. That's not the issue. The issue is having a plan and sticking to it and minimizing your risk. All right, why you should care about the Greeks. So that was the next topic. So here's your three Greeks. Delta is by far the most important one when you're scalping, because that's literally going to help you pick the right contract, and it's going to tell you how much money you could potentially make with that contract, which allows you to basically decide how much profit you want by selecting how many contracts you have. You control your profit by the size of your position, so how many contracts you have. And then your profit is controlled by the delta. So delta is how much the contract will move if the underlying moves $1. So if you have a 50 delta, or a 0.5 delta, and your contract moves 10 cents, or sorry, your underlying moves 10 cents, your contract is going to move 5 cents because you have a 50 delta. So that equates to 50 cents per contract on a dollar move. So if I do quick math and I divide by 10, that just gives me a very easy way to see the delta and know, it's just a smaller number to work with as opposed to trying to work with 0.5 on a dollar move. I can work with 0.05 on a 10-cent move. It's just it's easier to work with when you're scalping. So I take the delta and I divide by 10 right away. Think of delta as the speed at which your position will increase or decrease. How fast is that position going to move? On a shorter term scalp, a more narrow range. So let's say you're scalping resistance to resistance and it's 10 cents. You're going to want the fastest contract you can get. Vice, if you're getting a bigger scalp, like let's say the range is resistance to resistance is 50 cents, you're going to want a slower contract, but with more acceleration as it speeds up and gets faster, so you can maximize gain. That brings us to the next Greek, which is gamma. Gamma is how much the delta will move if the underlying moves $1. So if you have a 0.10 gamma and you have a 0.5 delta and the underlying moves 20 cents, your delta will increase from 0.5 to 0.52. All right, because you get per dollar underlying move, you get 0.10 increase on the delta. So if the underlying moves 10 cents, you get a 0.01 increase on the delta. So being that it moved 20 cents, it goes from 50 to 52. Think of gamma as the acceleration. So you got your delta, which is the speed at which your position will move, and then you got the gamma, which is the acceleration of your position. So this is how fast it's going, and this is how much, basically how much gas pedal is getting put into the position. So is it going to speed up or is it going to slow down? And this is the current speed. Theta, not important at all for scalping in my opinion. I don't even look at it because theta is the amount your contract decreases per day. Normally you're in a scalp for 5 minutes, 30 minutes. It's not that long. So looking at theta doesn't really make sense because it's how much your position decays per day. I don't swing trade options, so I'd care less about theta. But that's what theta is, in case you're wondering. All right, here's a brief options chain breakdown. This is on SPY for 23 August 2017. That's what we'll be using for an example for some follow-on slides. But there's a little quick visual example of how you can see the deltas and gammas within your options chain. You can add them in there. So right here on the 243 strikes for calls, I can see that there's a 47 delta with a 12 gamma. So that tells me right off the bat that if SPY goes up 10 cents, I'm going to make this delta is going to bring my contracts up 0.047 cents, so almost 5 cents. So this is going to read around 1.19, and then this is going to read around 1.22, just going off of the delta. And then I also know that on a 10 cent increase on the underlying, so if I have my gamma at 0.12, right, I'm going to get a 0.012 increase for every 10 cents. So if it underlying goes up 10 cents, my delta is going to change from 4.7 to about 4.8. All right, so this is quite a little brief example. So you got the speed at which your position is going to go up, and then you got the acceleration at which controls the speed, which controls the gain. All right, so time frames and indicators. This is what I use. Time frames, I use a weekly because and it has a number 1 here, 2, 3, 4, 5, and in order of importance. Not in order of which I trade, but in order of importance as pertaining to the world. So the weekly is where the big money is. That's where the hedge funds and the institution investors, they're hanging out in the weekly and daily because they're looking at the long-term trends. Because they got their clients' money in that stuff. So they're looking at the long-term trends on the weekly and daily. So when you get a weekly resistance break or support break, it's followed by a drastic move. And then that brings us next to the daily. The daily is the second most important because it's, again, where the big money hangs out. Big money is investing. That's where most of the market money goes, is into investments. Uh, Now, there is hedge funds, prop firms, and people that trade intraday, but your big money is going into investments. And investments are using bigger term trends, aka your weekly and your daily. So I use those also as support and resistance. 78 minute is probably something new to some of you. Probably never even heard of a 78 minute unless you've paid attention in chat to things I've said. But 78 minute is strictly for the algos, the algorithm trading, computer AI trading. Over half the entire stock market's volume, over half of it belongs to computers, computer trading, AIs, algos, quants, not even real people. It's it's just computerized trading. Trading off of set strategies. So 78 minute, and these are all, if you realize, these are all sequential fractions. So 1 week, 5 trading days. You divide that by 5, you get a day. You take a day and divide that by 5, you get 5 78-minute periods. You take a 78-minute period divided by 5, you get 15 minutes. Take a 15-minute period and divide by 5, you get 3 minutes. Now, where it comes into play, whether I'm using the 3-minute or 5-minute, is volume. If there's low volume, I'll stick with a higher time frame, aka the 5. Or if there's more volume, I'll stick with the 3-minute. And these are all just fractional time frames. And algorithms use these fractional time frames very heavily with what I've researched over time. So that's what I used to use hourly, and I started thinking about it. I was like, man, hourly doesn't even make sense because the stock market opens at 9:30 and it closes at 4. So there's that extra half hour that the hourly. I mean, what am I going to get? Half of a candle? Like, it doesn't make sense, mathematically. So when you use a 78 minute, you're getting 5 full candles during your day. So then the next part of this is moving averages. This is the only indicators I use for trades. It's all I use. Ichimoku Cloud is on there for a reason. We'll talk about it, but I trade off the moving averages because they're the oldest indicator out there. They've been around for 100 plus years. Moving averages were invented in like the early 1900s, like 1912 or somewhere around there. I can't remember. But over 100 years they've been around. Moving averages have been predicting stock price moves before the stock market even went electronic. So being that they're that old, they have a lot of validity behind it. They're used heavily because of how long they've been around. You know what I mean? Like it's like anything else that's old in the world. The more it's been around, the more people use it. And with an indicator in general, indicators are purely psychological. They only work if you make them work. That indicator is only going to, that VWAP or that SMA or that MACD, people are only going to buy and sell at those points if they make themselves buy and sell. If you're only going to get a bounce on a moving average if other people buy at the moving average. So it only works if you make it work. That's why an indicator, any indicator, any indicator out there, it's all 100% psychological. So you want to use the ones that have the most weight. And that's going to be the ones that's been around the longest, the ones that are used the most. There's other ones that's been around longer, not longer than a moving average, but there's other ones that's been around a long time. I mean, there's indicators out there that's been around for 50, 60, 40 years. There's decade-old indicators out there. But if somebody just came out with an indicator yesterday saying that it's the poo and it's awesome, it's making $1 million, don't use it because it's not going to have any validity. The market needs to accept it first for it to start working. If you're using these new indicators that came out this year or last year, you're probably not doing too well that you might have realized. So The moving averages that I use is 13 EMA. 13 EMA is very heavily used by day traders as well as institutional day traders, um, and also algorithms. And then the next is 20 SMA, 50 SMA, 100 SMA, and 200 SMA. These four are like the go-to prime moving averages in the stock market. You know, everybody knows about the 20, 50, 100, and 200. You can ask any trader out there, and they've heard of these. You know, I can go out and ask 10 traders right now, hey, have you heard of a 100 moving? Have you heard of the 200 SMA? They're gonna say yes. I could go out there and ask 10 traders, hey, have you heard of the Ichimoku cloud? You might get one or two no's. Ichimoku cloud is not a heavily used intraday indicator for retail traders. But the reason I use it is I use it on the 78-minute only, and that is for algorithms. So the Ichimoku cloud uses Fibonacci retracements, which go off of math, to calculate its plots. So being that it does that, it's already using math. Algorithms are using this because it's a math-based indicator. And on the 78-minute chart, when you're talking about higher term time frames for people that are trying to invest their clients' money, they're going to do it on a higher term time frame. Right here is a blown up picture of the 78-minute Ichimoku cloud. So you can see it's bouncing to the penny. It breaks down to the bottom, bounces to the penny again, and breaks before it breaks down completely. You can put a 78-minute chart on your platform right now with Ichimoku cloud, and I guarantee you're going to see tons of bounces because those algorithms are buying and selling right at those points. And if over half the market volume is algorithms, then you're going to get a lot of bounces and a lot of movement around those points. Next is volume, total buy sell. So I got total volume, buy volume, sell volume, and I use that on the 5 or 3 minute chart. Again, depending on overall volume, how liquid it is, that'll depend if I use a 5 or the 3, like I told you before. But those are the volumes that I use. So if I'm looking to get into something in a long position, aka calls, I'm going to look for increasing total volume up to the resistance break, and then I'm going to look for increasing buy volume over sell volume. That tells me that buyers are coming in and that overall volume increased. So it's going to give me a break. And when it breaks out, it'll most likely confirm. Another thing I use heavily is level 2 in time and sales. That just gives me a good picture of who's playing with me. Whether it's the different market makers out there. Some market makers are known for investing. Some market makers are known for manipulation. Some market makers are known for intraday trading. There's a lesson topic in the lessons channel in the chat room that goes over all the different market makers. So when you know them, you kind of know their habits. You can know what they're trying to do. That gives you a edge above the rest of the people that are out there not using it. So I use time and sales in level 2 pretty heavily. That allows me to see kind of where the trend is going before it happens, because all indicators are lagging. They're all price-based, volume-based, moves. So the move has to happen first for the indicator to show it, aka it is lagging behind the actual move. Time and sales level 2 kind of gives you the move as it's happening real time. So you see the order come through, boom, it's still lagging because the order's already happened, and then it posts on your time and sales, right? So it's still lagging. It's definitely not real time. The only way to be real time is if you had a camera sitting on every trader's computer out there in the world. That'd be real time. Even then it'd be lagging because of internet delay and stuff, but besides the point. Time and sales in level 2 is the closest thing you can get to real time. Any plot on your chart is going to be lagging, but they're still heavily used. Alright, so picking the right contract. When you're scalping, you want to look at risk reward for the implied move. Alright, so if you're scalping a small range, a 10%, or not 10%, but a 10 cents move, you can probably be a little riskier because the move is not that long. or you might want to manage risk because their move is not that long. But either way, you want to analyze how much money you're going to make and see if it's worth putting money into in the first place. So, like, let's say there was a resistance break of point A to point B, and it's only 5 cents before the next resistance. Well, even on a good delta, like let's say your delta is 60, right? So you're going to get 6 cents per 10-cent move. So being that it's only a 5-cent move, you're only going to get 3 cents per contract profit. Now, based off your commissions, that might not be worth it. You might want to wait for the next play, because you know, go ahead and take a penny or two out of there for commissions. Now you're only scalping 1 cent profit. That's not going to do you any good. So wait for the good plays. 10 cents scalp or more. Don't be trying to scalp 5-cent moves on the underlying because you're not going to make any money. All right, you're going to want to pick the right contract for the move you're playing. So if it's a small move, you're going to want a faster contract. That brings us back to the talking about the Greeks. So you're going to want a contract with more speed. If you're scalping a smaller range. So you're scalping a 10-cent range, 15-cent range, you're going to want the higher delta, which is going to be the in the money contract. That's going to give you the higher delta. So you're going to make more money. Gamma is not really important on a small move because it's not going to have time to affect. Gamma, a 0.10 gamma is only going to give you a penny increase on your delta for every 10 cents. So if you're only scalping a 10-cent move, the gamma is not even going to affect your delta. So that's why you want the higher delta that you can get. So when you're looking at the options chain, that's going to be your in the money contracts. So there's your in the money call, which is 6 cents higher on the delta, and then you got your in the money put, which is 7 cents higher, or not 7, 7 cents on the delta, not the contract, but so that's going to give you more capital. It's going to allow you to capitalize on a higher gain for that implied move. Vice, if you were playing a bigger term scalp, so let's say from point A to point B is like 40 cents, right? You're going to want a slower contract, which is going to give you more money over time, vice having a faster contract. So back here, now this is not a very good example of gammas helping you, but for a theoretical purpose, let's say that this gamma was, you got your 12 gamma here, and let's say like this was like 0.20 or 0.18, right? Or I'm sorry, you're gonna have higher out the money. So let's say like this was like 0.18, and then this was like 0.12, which it is right now. So on a short-term move, 0.12 is only going to give you a penny increase on your delta, which is not going to give you really any extra profit on a 10-cent underlying move. But let's say the underlying move was 40 cents, right? So if you went with this one, it'll give you 5 cents per 10 cents. So you're looking at around 20 cents on that move. 20 cents per contract, right? So this is going to give you up from 50 to 1.7. It's going to give you more money on that contract for that move, but if you go with a higher gamma, so let's say like this was like 0.20, all right, you're going to get a 0.2 or 0.02 increase on your delta for every 10 cents. So over the course of 40 cents, you're getting a 0.08 increase. So this is going to bring you up to 55 on that 40 that 40 cent underlying move. It's still not going to be higher than the other one, obviously, because these are going to go up, these are going to go up, but this is going to accelerate faster and potentially give you more profit on the move, because when you're looking at this move, right, you're getting 40 cents 40 cent underlying move with a 0.5 delta, so you're getting a 0.01 increase on your delta. So on a 40 cent move, this is going to go from 0.53 to 0.57, right? So you haven't even increased a penny yet. Um, so that's going to give you on a 40-cent move, you're going to get plus 20 on this. So you're going to be around like 170 on the ask, right? So you're only making 20 cents on this move. Now, if you were to go with the slower, faster accelerating move with a higher gamma, like let's say this was 0.20, right? And even though the delta's, even though you're making less money on the contract per 10-cent move, the delta is increasing rapidly. So on this 0.47, right, you're making point, 0.047 increase on your contracts per 10-cent move. So if it moves 10 cents, or it moves 40 cents, right, you're going to be making around 16, what is it? 4, 8, 16, right around 16 to 20 or 16 to 18 cent increase on your contracts. But if this was a point 0.2 gamma, then now you got that other beneficial factor to where if the underlying moves 10 cents, you're getting a 0.02 increase on your delta, right? So if it moves 40 cents, then you're getting that point 0.02, times 4. So you're getting that 0.8 increase. So by the time this gets that 40-cent move, this is going to be a lot higher than it is now, right? It's going to be plus 8. So you're going to get, assuming that this was 0.20, this is going to be plus 8 on a 40-cent move. So you're going to get that 55. So right off the bat, if this was a 0.20, right, and this is a 0.12, this is 53, this is 47. At the end of a 40-cent underlying move, I know that this is going to be 55. Now this is going to be over 55, right? But right off the bat, I know that this is going to be 55. So I can squeeze more money out of this because you're talking about a difference of making, going from a 1.17 and increasing damn near 20 cents, or over 20 cents. So on this range here, vice this range, which will be slightly less. It'd be more profit necessarily, or it could be more profit, but it's going to be less increase in your contracts based off the move. They're both going to go up, but you're going to get more movement with this one, which equates to more profit. If that makes sense. All right, so here's a brief example of the different time frames. So coming up here, weekly, daily, 78-minute, 15-minute, and then on my second screen, I'll have my 5-minute chart. So there's a 5-minute break of the 100 SMA. I trade off all SMAs, not just the 100. This just happens to be a 100 SMA break. So it's coming up and it breaks the 100 SMA. So when I was looking at the volume here, it had increased total volume and then it had increased buy volume. It broke, but you got to wait for confirmation. Confirmation is the next candle when it confirms above. So it opened above that resistance. So that would have been an entry. All right, sorry, it was an entry. And then I'm expecting an 80-cent move to the next resistance on the 5-minute, right? So then I scale over here to the 15-minute, and I'm like, oh crap, I've got a 40-cent move to next resistance. So that's going to be a scale out point, or a bailout point. So when this 15, and then I'm checking the 78-minute, I'm checking the daily as well for those resistance and supports. But so from here, I'm gonna get a 40-cent move. I have to get past this 40-cent move before I can get to the 80-cent move. So if I do get past this 40-cent move, I'm gonna scale out. I'm gonna lock some profits in. If I have, say, 20 contracts, I'm gonna drop probably 10 of them to lock in the gain I've got from those 10. So if I have 20 contracts and it runs up and I hit my resistance point, as soon as it hits, I'm gonna be looking to scale out. Like I'm not looking for it to break. I'm looking for it to hit, because as soon as it hits, I'm gonna be looking to scale out. And then once it confirms above, I'll continue to hold. as long as we're still holding the 5-minute 13 EMA, which I'll talk about. But and let's say it denied that 15-minute and came crashing back down, broke through the 13, then I would bail out. But at least I'm scaling out and trying to lock in some profits. So if it breaks out of that 15-minute, then we're good. We're on course for our 5-minute. So when it comes up to the 5-minute, now you got your 80-cent move, you're racking in the money, and then bam, it hits your resistance. It shows a reversal signal with this gravestone doji. If you don't know much about candlesticks, you should learn about them because they can help you significantly in scalps when you're looking at intraday candle formations, different types of candles, and what they mean. They can definitely help you with reversal signals, whether you're long or short, calls or puts. But like without even seeing the rest of this chart, I can tell you that if this was coming up, and this happened real time. This was a play I made, but I could tell you right away that this is a reversal because you got this giant run with a gravestone doji. Gravestone doji is signaling bulls trying to push it up, sellers smacking it back down, pretty much all the way down to where it opened. Which is what a doji is. It's getting indecision down to where it opened. So bulls try to push this up, sellers smacked it down, and then guess what happens? The next candle opens up and tanks because the bulls got out because it couldn't break resistance. So it's a brief example of scalping the ranges. So you got your 80-cent 5-minute move, and you got your 40-cent 15-minute move. Scale out after the break here. If it continues to run, which it did, then you drop your other part of your position at the resistance failure. If it breaks out resistance, then you scale out some more. So if you scaled out half here and it runs up to the next resistance on the 5, scale out half of that half. So you have 25% left, and then wait for it to run up to the next resistance. All right, so that brings me next to the play. And that's just the overall, what I'm gonna do while I'm in the positions. So entering, when to enter. You're gonna enter on support, bounce, resistance breaks. That's reversed for calls versus puts. So on a call, resistance is the upside. On puts, resistance is the downside because it's resisting going down. And then you're gonna want volume coming in, buy or sell volume for your calls or your puts. So you're going to want an increase in buy volume or an increase in sell volume depending on whether your calls or puts. And that's going to be at those resistance and support points like I showed you on here. You're going to want to increase in buy volume if you're trying to get into calls on this break. You're not going to want to be looking at increase in sell volume here because that's going to tell you it's going to come back down most likely. You're going to want increase in buy volume. All right, and that can be annotated right here, increase in buy volume. Now, this platform is TradeStation, so you're not going to have that same volume indicator in Thinkorswim, but I did make a Thinkorswim total buy and sell volume script. It's in the free tools channel, so you can find it in there in the Google Drive. It's essentially the same thing as this, but it's all on one layer. So you're going to have total volume white, and then or whatever color you set it to, and then your buy volume is going to be green, and your red volume is going to be, or your sell volume is going to be red, but it's all going to be on the same layer. It'll just like overshadow each other, depending on which one's bigger. All right, and then so hold. You're going to hold the position, or I'm going to hold a position as long as it holds the 13 EMA. Right, so on this move, I trade off the 5-minute, and I use the rest of the time frames for support and resistance. But I'm trading off the 5-minute. As long as it's holding this 13 EMA light blue line, I'm still in. Right, so it held this entire time up into the resistance of the 80-cent move I was expecting. So as long as it's holding, I'm in. I'm not getting out. There's no reason to get out. If it breaks, I'll get out. But as long as it holds, I'm staying in. And it held. So blew past the 40-cent range on the 15-minute, scaled out half, came up to the next resistance on the 80-cent move, and I scaled out I bailed out of the second half, so completely out of the move. because it couldn't break out. So I got 40 cents on the first half and 80 cents on the second half. All right, which brings you down to you're scaling out. If it breaks the next resistance, go ahead and lock in some gains. Or if you're double your daily goal, you should immediately lock in that daily goal because that's your daily goal. If your daily goal is 300 bucks, then lock it in by if you're up $600, lock in that daily goal by selling half of your position. So you're up 600 bucks, sell half, now you're up 300. You could lose that other 300 and you'll still have your daily goal. So definitely lock in your daily goal when it presents itself. The next part is exit fully. So at resistance, break failure, or reversal sign, or when you're satisfied. If you're green, there's no such thing as a bad exit. All right. If you're up and you make money on the play, then there's no such thing as a bad exit. You exited with money in your hand. That's good. There's nothing bad about that. But you definitely want to make sure you're exiting on the right signals. Don't just don't just exit to exit. I mean, if you're up substantially, go ahead and exit to exit. Why not? You're up. But if you're only up a couple bucks, 10, 20, 30 bucks, you might want to hold on if there's no sell signal, because if this gravestone doji didn't form and it kept pushing up, I probably would have kept holding and see if it broke the resistance. And then the next candle would have confirmed or not. But being that this gravestone doji tried to tap it and formed, that was a sell signal. So that was an exit. Um, that would give you the reversal signal. Or when you're satisfied, if you're up enough, go ahead and bail out. So that's basically the play of getting in while you're in and then getting out. So a quick overcap. All right. We talked about trading rules, how the Greeks affect your scalps, the time frames and indicators I use and why, picking the proper contract for the move, and then when to enter, hold, scale out, and exit. Hopefully this kind of answered a lot of questions for people looking to get into scalping. If I didn't say it already, I only trade SPY because SPY is, I mean, you can apply this lesson to any ticker. I personally only trade SPY. I've been trading only SPY all year because it's liquid enough every day to where I don't need to trade anything else. I can make enough money on SPY every day, and I don't need to trade anything else. I don't need to be searching through a whole screen full of scanners trying to find a play when I can just focus on one every day and learn it. As you start to play one ticker, you can learn its habits. Like you can learn when it dumps and hours of the day that it's moving, and you learn the ticker. When you're playing a million tickers, you can't learn them. You're not in it every day. You don't know what's happening every day. So sticking to one ticker can definitely help your odds as well as mitigate your risk. And I'm all about risk mitigation. I try to make my stock trading as low risk as possible. So I'm not going. That's why I don't swing. I don't swing anything because you can't control what's happening after hours. There is after hours trading on stocks. There is not after hours trading on options. So if some stuff goes down with the ticker that you're in and decides to just dump or spike, that could severely affect your calls or puts. You can't do anything about it until the next day. So that's unnecessary risk that I don't want anything to do with. So I just stay clear of swinging. But yeah, hopefully this answered a lot of questions for anybody. If you have any more further questions, feel free to reach out into the chat room. And anybody, including myself, would be able to answer them. That's the end of this lesson. But just remember that it's not a race. It's a marathon. So trading is not going to get you from $1,000 to 10 grand in one day. It most certainly could. It's happened for people who just go all in on a pump and dump or something. But I mean, that's 100% risk. Like you want to mitigate risk as much as possible to preserve your capital. You make these small, slow gains, and at the end of the year, you got a giant bucket of money advice if you're trying to go all in or 50% in, and yeah, you might get lucky and strike it, but what happens when you lose, right? You're going to lose a giant portion of your overall capital. So, just making $300 a day is 75 grand a year. If you want to target more than that, target more than that. But I mean, for people that work like myself, I work in the evenings, and I'm never going to quit my job unless I get fired because it's like the easiest job I've ever had. So if I can make $300 a day, which gives me 75 grand a year, I'm basically doubling my yearly income uh, by trading. If it if I get fired from that job or if I quit from that job, then I would go full-time trading. But I got no reason to right now, so I'll stick with that $300 a day goal until I have to raise it. Because right now it's a very substantially easy goal to hit. It's not hard to hit at all with the proper risk mitigation and the proper sizes of your contracts. So hopefully this lesson helped you all. Hope you have a good day. I'll catch you later.